Hello everyone, welcome to today's lecture. So today we are going to discuss about liabilities of auditor. Okay. Now, what I will be doing is I will be explaining the provisions. I will be explaining you in detail the sections and the concept. We will see some questions and then we will we will also simultaneously take queries and resolve queries. And if you guys have any query with respect to any of the topic, not only this, but any of the topic, please post it. I'll take it up as and when we'll get the gap between two topics, or as and when we will receive the query. But please post it. Okay. So the today's topic is liabilities of auditor. Now, in case of a liability of an auditor, first we need to understand from where the liability is arising, for what the liability is arising, okay, and to respect to which topic the liability is arising. Okay, so in case of a liability, now it is not something that the auditor is required to pay from day one. It is not like that the auditor has to pay in respect of that it's mandatory liability. But what is this liability is, see, when we talk about performing an audit, okay, so we do have some responsibilities. Now when we talk about responsibilities, now responsibilities falls under into various categories and various responsibilities enacted by various acts and legal laws. It's not only just one plain law that puts responsibility on the auditor, but yes, there are various laws and regulations. Now we do have a great responsibility because we do have great powers. With great powers there is a great responsibility. Now if there is breach of that responsibility, or if you do not adhere or do not comply with the responsibilities, then in that case you will become liable as an auditor. Okay. Now when I say you will become liable, at that point in time your liability will arise. Now let's say, for example, as an auditor, we are required to perform audit by ourselves. We are required to review. As a signing partner, I'm required to review. Okay. Now today, can you delegate that particular task to someone else, or can you ask someone else to perform on your behalf? Yes, but subject to certain conditions. Okay. But in most of the cases, it's like a personal thing. You cannot ask anyone. You can ask a specific person. Today, if you want to go to perform an audit, you can ask another chartered accountant in practice or a partner to uh, perform the audit on your behalf. Okay, but still, if you are signing, you are liable. You need to see everything. Okay, so if you are signing the audit, you need to ensure that everything is done correctly and everything is appropriate. Now the question arises that if we cannot delegate fully, or if we cannot transfer the responsibility fully, then uh, in that case, we if we sign, we are still liable to for things that are there in that particular audit report. We are liable to ensure, we are liable that we need to ensure that the audit is being performed appropriately, adhering to the generally accepted auditing standards, and that's where the liability of the auditor arises. Okay, so when I talk about liability of the auditor, liability of auditor is something related to the duties of the auditor. If you do not fulfill the duty, then in that case your liability will arise. Your liability will arise. Okay, so there are various provisions in professional ethics chapter we saw. When you do not perform your duties, you will be held guilty of professional misconduct. We'll see that in detail. Okay, but As of now, we'll understand that, okay, when I talk about the liability term, liability relates to the duties that are required to be performed by auditor. Okay. So liability is related to the duties that are required to be performed by an auditor. When auditor is not able to perform the duties, uh, when auditor is not able to perform the duties in professional capacity, then he is liable. And if he is liable, to whom? To stakeholders. Okay, for the duties he was supposed to perform. And in case when I say liable, for what he is liable? For liable for the damages, loss, breach of trust. Clear? Now, for example, auditor was required to perform audit as per SA, but uh, auditor failed to perform. Auditor did not comply with SA. In that case, he will be held liable to the stakeholders, creditors, government authority, bank. So all these are stakeholders. He'll be liable to them. Now, when I talk about liability, liability can be of two types. One, civil nature, one, criminal nature. Okay. When I talk about civil nature, it's a civil liability that, for it's related to civil punishments. And but when I talk about criminal liability, it's a criminal breach of trust, or with an malified intention. So there are generally they are divided in two categories: criminal and civil. Okay. Now, when I talk about non-performance of duties, okay, performance of duties generally, are called as in professional negligence. You will see that particular term, being used uh, throughout this particular lecture, the professional negligence. Now, when I talk about professional negligence, there are three types of professional negligence. One, negligence related to existence of duty and responsibility, that like I was supposed to take care a certain degree of professional care and competence, but I did not. Okay, so I did not take care the professional care and competence. Second type of negligence duty, negligence is occurrence of breach. So there is a breach of duty. Third is loss or damages being suffered by the party to whom I was supposed to be what you can say. Uh, I was supposed to be liable to them, or I was supposed to fulfill the duties for them. So first there was a duty. Second, there was a breach of the duty. Then there is a loss. Clear? Any doubt till now? So when I say negligence, it's with three elements, that are there was a duty, there was a breach of such duty, and due to breach there is a loss. Okay. Now, when I say there was a duty, means duty to exercise care, skill, knowledge, competence. That is the term duty. When I use the term duty, that duty means that I was supposed to use my knowledge, I was supposed to exercise my skill, I was supposed to take care of certain items, and I was supposed to demonstrate my competence while discharging any of the task, assignment, or engagement. Okay. So basically that becomes my professional negligence. Let's say, for example, I'll take an example here. I'll take fraudulent reporting. Now, in case of fraudulent reporting, okay, or you can say, I performed reporting which was not correct. I haven't actually, but just an example, just to understand. So fraudulent reporting, in this case, there was a duty, okay, duty to report. Breach of duty means I reported fraudulently reported. So there is a breach. Then there is a loss. Because of this fraudulent reporting, there should be loss to someone or stakeholders. And that will become my professional negligence. Clear? Now, loss can be suffered by any of the, you can say, stakeholder. It can be a client, it can be a creditor, government department, okay, or banks, financial institutions. So it can be, suffered by any of these stakeholders. Now, there is a particular question. What if, the loss is suffered by a third party who is not privy to the contract or the arrangement? Okay. Who or contract, like, the client and auditor. So how will we determine that, that, okay, loss has been suffered by that particular person is falls under this particular category? So there are various legal case scenarios, decisions. I will be discussing that case scenarios and decisions also. You can say, I have, in study material, the case scenarios are bifurcated in 3 categories. American scene, okay, the scene in United States. English one, the case and the scenarios in UK or, England, and the Indian scene. So I'll explain that in a while. But as of now, we'll park it that, okay, what happens? How do we identify who are these stakeholders? So for that, we will see the case scenarios. But as of now, it's very important to understand to whom we owe the duty. We owe the duty to the, you can say, stakeholders. Any doubt? See, okay, very good question. Only stakeholders can find the professional negligence or third party can raise it. Yes, third party can, but subject to certain conditions, and we'll see in the case scenarios in different cases what was the scenario. Okay. Then the next question is, by definition, if there is no loss, then it is not a professional negligence. Sorry. See, with respect to professional loss, okay. Now there are two kind of things, two things which are specified. One, loss. The term loss is specified. The term loss is mentioned, or it is said that, it is detriment being, or any, any loss or detriment suffered by the party. So detriment, if you check for the detriment, the term detrimental or detriment generally, refers to the adverse side. Okay, cause or harm, or something to adverse or to a particular person. Now, in that case, what happens is, if that person has suffered loss or has any harm, or has any caused any, has suffered at any of the issue, then yes, it will be counted negligence. But what if the person has not suffered? See, again, the clarity and, you can say the scenario depends upon type of breach, I would say, rather than the loss, which type of breach of duty it is. Because in some cases, you would find under the statute that there is a by default assumption that there is a loss. Now, I'll just take an example. Reporting of fraud under section 143.12. Now, if you do not comply, okay, if you do not comply with that particular section, we saw there are certain penalties. Penalty under section 143.15. Like, there are different penalties there for 143.12. Okay. So for listed company, for other companies, so there are specified penalties. Now, if you do not comply with 143.12 or with other sections also, let's say for example, there are penalties specified in other sections with respect to non-compliance. Okay, in that case, there is no actual loss to any person, but it is assumed that there is a loss. That's why there is a penalty. And if there is a penalty, then the auditor is liable. Auditor will be liable for professional negligence. So on the basis of that only, the liability arises. So it's not more about the penalties, it's more about the breach that is there. Section 147 again imposes penalties for breach in certain cases on the on the auditor. Section 139 for breach of 144, for breach of 145. Okay, now if you see those sections, it says that it assumes that there is a loss, and that's why there is a penalty. So again, I'll say it's not important how much and in which quantum the loss is suffered. Sometimes it's a deemed loss, it's assumed there is a loss, okay, to the government authority, but the important is a breach of duty. So as I said, loss doesn't only mean in monetary terms. Yeah. Any doubt? Any doubt? Okay. Well, providing incorrect information. Now, if you provide incorrect information to any of the government authority, it is by default assumed there is a loss. Okay. So they will not, say wait till the time the government actually suffers the loss. By default, it will be assumed that they have suffered the loss, and you will be charged with penalty, and you will be charged with appropriate penalties and punishments. So providing false and incorrect information will directly have an impact. It's not that that we need to wait till the time anyone actually suffers the loss. I hope I'm clear. Okay. Let's see some of the let's go into the deep with respect to the each and every scenario, like as I told you, to whom we are liable. Now there are various case laws, okay, English case law, Americans and Indian. We'll see, understand each and every scenario that okay, to whom we are liable. Actually, till now we saw we are liable to stakeholders, but how? Okay, now generally liable only to the company. That was not there. It is the case in the UK. Okay, we are only liable to the company. Second case is we are liable to the known parties. Okay, that is in the American scenario. Means if you know the party, you are liable to him. And third option is, or second option basically over here is liable to all whosoever relied upon the audit report. Okay. So whosoever relied upon the audit report, we are liable to them. Now that is the concept and the the logic that is appropriately followed in India. But let's see again one of I'll explain one of the case, basically a good case in the English scene that says for the liability of the UK, like liability in the case of UK. So if I talk about a particular case scenario in UK law, basically it's Candler versus Crane Christmas and Company. So that was a case wherein this question arises. Okay, who is liable? Like to whom we are liable? Now the thing was that there was a firm of accountant that was engaged by the company, okay, to prepare the company's account. Now the accountants that were there who were supposed to prepare the account, they knew, okay, that the statement of accounts will be shown to the third person. So they were aware that okay, my statements or accounts that I will prepare will go to the third person, and third person will rely upon that. Okay, that is the statement that we have prepared. Now what happened is later on there was a company who relied upon the statement and invested in the company. However, the statement were not prepared appropriately and the company lost its money. The company who relied upon the statement, they lost their money. Now the question here was whether the company who relied upon the statement and invested in the company, okay, can held or can hold the person who has prepared the statement liable. Okay, but understand there was a breach, or you can say there was a negligence, but there was no fraud. So there was no intention to deceive someone. There was no malified intention over here. There was a miss out of things. There was a negligence, you can say, rather than the fraud. There was a case of negligence. In that case, it was held that accountants or the person who has prepared the statement owe a duty of care not to their own clients but to also those who rely upon the statements that have been prepared by the accountants. So that was the first case where this particular concept arises, that to whom we are liable. So in the Candler versus Crane, it was decided no, if we are preparing something and if someone is relying upon that particular statement, we are liable to that particular person. Okay, now to what extent, it depends upon case to case basis, but yes, we are liable. So there are other cases also where different opinions were taken, like Hadley Bryan and Heller Partners case was there, where there was a different opinion than this one. There was an opinion that so there was an opinion that no, the accountants are not liable. But again, there are various cases where you will find favorable judgment and you will find unfavorable judgment or against that. So I'll just explain you a bit of the scenario. There was another case, which was Jeff Fasteners and company case. Okay. Now, they in that particular case, the concept of the special relation principle was brought into. Okay. Now there was what was the scenario? I'll just explain of the case quickly. What was the scenario in that particular case? In Jeff Fasteners, Mark Blumen company case, what happened is the auditor that reported upon the financial statement of a particular company, let's say XYZ company, So auditor prepared the audit report on a financial statement of a particular company. Okay. Now, accordingly, the stock was valued of that particular company and in that financials, and the stock was valued basis of X methodology instead of Y. Let's say we used to value stock as costed and or NRV, whichever is less. In that case, stock was valued due to based on some different methodology. Okay, and the cost, let's say for example, based on the different methodology, it was 23,000 rupees for the sake of example. However, actual cost was 11,000 rupees. So they overstated because of the different methodology. Company was aware about many problems. Auditors were aware about many problems of the company, like liquidity problems were there, and inside working and everything. So they were aware about the liquidity problems and inside problems. Then there was a takeover that was going on. Okay, so there was a takeover that was going on at that particular time. Okay, but the takeover was not successful. Now the takeover was not successful. Reason because there were some issues identified during the takeover. Okay, and the auditors were also involved in the takeover of the company. Now later on, when the person who was supposed to purchase the company, that person claimed or filed a case against the auditor because he on the grounds that the auditor misguided them or misstated the financial statement, and they because of them they they made that person into purchasing the company. Okay, by preparing wrong financial statement. So there was that the auditor, there was a breach of duty that they did not prepare the financial statement appropriately. Okay, and their audit reports was wrong. So that was the whole scenario in that particular company. So now what was ruled, okay, in that particular company was there was a concept of reasonable foresight and a special relationship test. So special relationship test was the concept in earlier cases also identified. Here what the thing and what the things were in the question was that is there any damage suffered by the person who was going to purchase the company? Is there any relationship for the damage that the person has suffered that was going to purchase the company because of the carelessness of the auditors? That was the first question. The second question, okay, was whether there are any considerations which are required to be taken into care, which reduces the scope or limit of duty of the person of the auditor. So the second question was like, if we think that okay, auditor is liable to everyone, then it will become unlimited liability. So are there any limitations to the liability? Was auditor actually liable to that particular person? Okay, so it was held that there was a lack of causal connection between the auditor and the loss that the person suffered during that takeover, because he invested his time and some money for the takeover. Later on, the takeover decided not to go ahead, but there is a lack of connection between both. Okay, and in that case, in that particular judgment, it was held that if there is no connection or direct connection between the loss that the person has suffered and the responsibility or the act or negligence or breach of duty by auditor, then in that case it cannot be held that the person or the auditor is liable. So if I simplify, let's say for example, let's say Mr. X was an auditor And in financial statement, okay, in financial statement, I'll not go with the fraudulent intention, and just let's say by negligence. In financial statement, by negligence, the fixed assets were overstated by, let's say, rupees 50,000. Okay. Company entered into transaction or contract basically with X, with not X, X is auditor. So with ABC Limited. Now this company, let's say XYZ Limited entered into a transaction with ABC Limited. Okay. For the purpose of supply of goods. Okay. Now there was a condition that ABC can only award the transaction, only award the contract. ABC Limited will only award the contract to companies who had past experience in catering such type of requirement. Okay. Like, ABC Limited said, okay, type of requirement, then only ABC company will give the contract of procuring goods to to any other company. So ABC Limited will only procure the goods from company who has past experience for supply of these goods. So XYZ company got the contract, and they were supposed to supply the goods. Now XYZ Limited was not able to supply because of XYZ reason. Okay. Now ABC Limited sued Mr. X that ABC relied upon Mr. X audit report to understand the before awarding the contract. Okay. So ABC sued Mr. X that ABC relied upon the Mr. X audit report under the to supply or to provide the contract to XYZ Limited, just so that they can understand what is the financial position of the company, and they awarded the contract because there was a overvaluation of fixed asset by 50,000. They sued X Limited. Now the same question, these are the kind of similar scenarios of the case I'm talking about. Jeff Fastener, Marks and Blumen Company. Same way, if there is no direct relation between the loss that has been suffered by ABC Limited and the audit report that has been published by X Limited, if there is no direct connection, now there was a breach of duty by XYZ Limited, they were not able to supply, because of which ABC Limited sued X, the auditor, that he relied upon the audit report and awarded the contract to the XYZ Limited. Here, if there is no direct connection between the loss suffered by ABC Limited and the activity that is performed by X Limited, in that case, can auditor be held liable? Answer is no. Based on this scenario, no. That is the main thing we need to understand. Again, that is an example which was there in English law. When I talk about English law, it's pertain to England, UK. So this is in case law of English law, basically, not Indian. I'll come to that also. How the Indian law has established its requirement and how the Indian law works here. But the concept is very good to understand how the concepts work. So basically, this here, the concept is, first of all, you need to understand whether there is a relationship, special relationship between the person and the person who has suffered the loss, like the Mr. X and X ABC Limited company. That's a special relation test. Second is reasonable foresight test. The reasonable foresight test talks about whether, okay, whether the person has suffered, okay, the losses because of the reliance or he was supposed to apply his own care and skill. Okay. So when I talk about basically the concept of the connection and establishment, so there were three conditions which were laid down in that particular case. Okay, that was also established and discussed in other cases. So the conditions were, let me. Okay, so in English law, there were three conditions that were discussed and finalized by the judges, that for a duty to exist. So if these three conditions satisfy, means there is a duty that exists. Okay, number one, the person, okay, need to be fully aware of the transaction, nature of the transaction. The plaintiff, or in this case, let's say for example, Mr. X, the auditor, is required to be aware of the full transaction that ABC Limited is going to take. So the person, or I will say defendant here. Defendant means the person who is defending himself, maybe a audit firm or auditor or accountant. The person defendant would need to be fully aware of the nature of the transaction that plaintiff had in mind, that the plaintiff. Now, when I talk about the plaintiff, it will be, let's say, for example, ABC Limited in our example. So I'll write in blue. If you take our example, it's ABC Limited. If I talk about the defendant, it will be Mr. X Auditor. ABC Limited Purchasing Company. Okay. So the plaintiff had in mind means Mr. X should be aware that, okay, why and what ABC Limited is going to do, or what transaction ABC Limited is going to perform with the XYZ Limited. Okay. Number two, he must know that his advice or information would be directly or indirectly communicated to the plaintiff. So the defendant or the person must know that his advice would be directly or indirectly communicated to the plaintiff. Now, in this case, plaintiff will be again ABC Limited and defendant will be Mr. X. So, Mr. X was aware that his advice will be communicated to ABC Limited. Third, Mr. X must know, or the defendant must know, that the ABC Limited or the plaintiff will rely or was likely to rely on the advice or information in deciding the transaction. So, the defendant must know that the plaintiff was likely to rely on the advice, okay, or information in deciding on the transaction, okay, in deciding on the transaction that plaintiff had in his mind. In our case, the transaction was purchase of goods from XYZ Limited. Now, if Mr. X was aware that ABC Limited, what transaction ABC Limited is going to perform, if Mr. X was aware that yes, ABC Limited will rely upon, or the financial statement will be communicated to the ABC Limited, Mr. X was aware that the financials will be communicated to the ABC Limited. And third, Mr. X must know that that ABC Limited will rely upon his advice, or in our case, the financial statement or the audit report, before entering into the transaction or while deciding that they should enter into the transaction or not. In our example that we discussed here, ABC Limited's requirement was that the person should be able to have the experience, not the financial statement. And second thing is, Mr. X was not aware that there will be any such transaction with the ABC Limited. Okay. So in that case, can Mr. X be held liable? Answer is no. That was the lacking. That's the concept over here, that Mr. X was not liable. Reason because there was no reasonable foresight available that that his financial statement will be used by ABC Limited for purpose of transaction, and ABC Limited has relied upon. Okay. So that is the scenario in English law, basically. That we discussed was the English law. Any doubts? Okay. Then let's go to the second type of scenario where there's an American law in picture. And why we are looking this? Because based on this only, the third one is the Indian law. We will have a good clarity when we will discuss that. In American, the common liability of the auditor is divided into two categories. Unlike the in English, if you see the English law is more onto the precedents. Okay, it's more onto the precedents and the jurisprudence that is available. But when I talk about English law, sorry, American law. American law is pretty much defined, well defined in that scenario. It's codified, more codified. Okay. So in American scenario, what is the condition is that the common liability of the auditor is divided into two parts. Okay, with two classes basically, and that is only related to the third party I'm talking about. Third party who is not privy to the contract. So the common liability is divided into two classes with respect to the third party, okay, which are not privy to the contract. Okay. So here the two parties or two classes are: one, primary beneficiary; second, other beneficiary. Okay. Now, when I say primary beneficiary is the is the one who is identified to the auditor by name. So auditor knows him by the name, and who is to be the primary recipient of the audit report. So if I talk about this primary beneficiary, means auditor knows him by name, and and that should be prior to the audit. Plus, he is to be primary recipient of the auditor's report. Okay, he is to be the primary recipient of the auditor's report. So that is the person, you can say, the primary recipient or primary beneficiary. The second type and category is your other beneficiaries, basically. Okay. Now, when I call an other beneficiary, for other beneficiary are the unnamed third parties. So these are the unnamed third parties. Okay. So these are the unnamed third parties who are not aware to the auditor. Okay. Auditor does not know. So if you say all parties, all third parties other than the primary beneficiaries are other beneficiaries. Now, what is the liability of the auditor in both cases towards the primary beneficiary and other beneficiary? So in the American law, the auditor is liable to all the third parties for the gross negligence and the fraud under the law. Okay. So fraud, gross, so again, I'll divide for the gross negligence and fraud and the ordinary negligence. So gross negligence and ordinary negligence. Okay. Now, for auditor's liability, if I talk about, for gross negligence, for ordinary negligence. So for gross negligence, all third parties. Which includes fraud also. So gross negligence and fraud under the law, all third parties are included. But when I talk about ordinary negligence, okay, then there is a difference between the two classes. There is a difference arises for ordinary negligence. Okay. So for the liabilities towards the other beneficiaries, okay. So again, there are various case laws which decide, okay, in case of other negligence, what should be the thing. So there are various different case laws in American what you can say American law also. Let's say, for example, I'll quote some of them for your reference, like Ultrameus Corp versus Touche. Okay. Now it's part of another group. This particular Touche company is a part of the accountant is part of another group. Okay. So here, what it was held that in this particular case scenario, it was held that the auditor guilty of negligence, the auditor was identified guilty for the negligence, but he was not held liable to any third party or other third parties for the negligence except for the primary. Okay. So it was held that, okay, he can be held liable for the ordinary negligence to the primary beneficiary, but he was not held liable to the other beneficiaries. So that was the scenario that was held, that auditor is not liable to other third parties in case of ordinary negligence. Okay. Okay. Now, the question is, this was a particular case which was, I think 37-year-old case is this law, Ultrameus, and that has been still from 1968 being referred to by various, courts in US. There are other cases also, Rush Factories versus Levin, and you can say where the same decision has been taken, but there is a different thing, different concept over here. Now there are scenarios where the in case of ordinary negligence, the particular accountant, or in case of US it's a CPA, he was held liable. Okay. because there was a concept which was deemed, what you can say, as I said, in primary beneficiary, the auditors knows him by the name. Okay, but there was another concept which was brought, deemed awareness, you can say. Okay, and this was brought in the case of in the case of Rush Factories, sorry, Rush Factors Incorporation versus Levin. Over here, now the thing was that, in this particular case, the Rush Factors, took the audit report and filed with the bank for a loan. So accountant was aware that, his audit report will go to the bank for the purpose of loan, and bank provided the loan, and there was a, issue in that particular audit report, and later that particular client, the Rush Factors, was declared insolvent. Okay, so in this case, now there was a thing that, that on what basis that particular, auditor can be held liable. His audit report went to the bank for a loan. Okay, now these were the certified statements or financial statement. Now later on, the borrower was declared insolvent because there was some issue. So in this case, it was held that, the accountant will be liable for the negligence for the care of financial misrepresentation. Okay, because the defendant knew that his certification would be used for the potential financial procurement or loan of the corporation. So he was deemed aware that, that his particular financial statement at later point in time will be used for the loan. So the concept of the deemed awareness was brought and he was held liable. Clear? Any doubt till now? Okay. Now, why I'm discussing here this particular scenario? The reason, because to give you the clarity about the topic. Now, our laws, our regulations in India, somewhere, when they are drafted, they are based on these particular, principles only. They are on the basis of these principles only. Okay. So if I talk about Indian laws and regulations, again, if you see, they are based on this principle that the auditor should be aware or deemed awareness, and I'll discuss that in detail. Okay. So in case of Indian law, the law that is majorly applicable to us. Okay, there is one case law. If you want, you can refer, and there are others also. CIT versus GM Dandekar. Okay, so here the decision that auditor's liability to the third party was decided by the Indian courts. Okay, and it was held that in this particular case, it was held that there was a there was a matter with the Madras High Court where was the Mr. Dandekar or GM Dandekar was under obligation to perform the audit with auditing skills and diligence. However, he did that, but there was a negligence on his part. So the accountant here was required to prepare and was required to present the correct financial statements. So in this case, what was held that that the liability, it was held that the auditor is responsible to all those persons for negligence who had relied upon the financial accounts of statement prepared by him, which is incorrect. Okay, the Indian courts followed the judgment that we discussed in case of like English law, or I discussed the case here, Candler Crane and Christmas Company, or Jeff Fasteners, which I discussed. So here they relied upon this particular case, and these conditions, that if the person has relied upon, okay, the auditor's report, or the auditor is responsible to all those parties, for negligence, who has relied upon the financial statement prepared by the auditor, okay, which are incorrect. So in that case, these cases were relied upon. So in this case, it was held that the auditor is responsible to all those, okay, persons for negligence who had relied on a financial statement prepared by him, which is incorrect. Okay. So here it was necessary to say that there was a negligence, and there was a person has relied upon that particular financial statement. So it is necessary to prove that there was a deviation from the standard of care which he was expected to exercise to perform his duty. So first of all, focus on the term negligence. There should be a negligence, okay. There should be a reliance, okay. So there are the two important things that are required to be taken care while deciding the liability of an auditor. That there was a negligence, okay. It is necessary to prove that there is a deviation from the standard care that the auditor is required to have while discharging his duties or performing a particular engagement, let's say audit or any other assignment that he has to perform. So there should be a deviation from the standard of care, okay, and where he was expected to exercise his duties, or that particular care in performance of his duties. So like for example, someone expected me to exercise the standard care in this particular engagement. If I give a classic example, let's say for example, there was a agreed upon procedures engagement where I was only required to check the arithmetical accuracy. If there is any issue with respect to the underlying transaction, was I expected to perform that particular standard of care that a person or an auditor used to perform in the case of an audit? It was only agreed upon procedures, okay. So when I say relied upon, means that there is an expectation, okay, to exercise the standard care uh, in performance of his duties. Okay, so there should be an expectation from which there is a negligence or deviation. Basically, when I talk about negligence, so there's a deviation from the expected standard care, okay, that was supposed to be exercised. Now, if I, while checking the arithmetical accuracy in case of an agreed upon procedures, it is not expected from me that I will perform the audit. If the person has relied upon the financial statement with an expectation that, this is an audited financial statement where I have specifically mentioned that this is a agreed upon procedure where I have only checked the arithmetical accuracy. In that case, there is no deviation from the expected standard care. The expected standard care in the assignment was to check the arithmetic accuracy. Okay, so this is the very important thing that we need to understand. There is a negligence, means deviation from the expected standard care. And second thing is the person has relied on the financial statement, means his expectation. So relied means he had expectations that the auditor will exercise his standard care in the performance of his duty, means the expected standard care. There are various cases to decide upon the civil liability in case of auditor. There are various numerous cases which are there, but see, this is a very important concept. We need to understand that how the liability is decided. What is the basic ground to decide the liability? I hope I'm clear. I hope I'm clear. Any doubt till now? Okay. Now I'll show you one of the report. I'll see why we are discussing English law, American law, or various different laws. I'll show you in a while. Let's say there are some questions. Let me take that. So there is question that auditor is only liable with whom there is a connection or otherwise. So again, these two conditions, negligence and reliance. Whether English law is applicable to our country, I'll come in a while. I'll come in a while to discuss a case. We are following Companies Act and regulation. I'll also discuss the Companies Act and regulation. And why I'm discussing this is because just to make you understand the concept first. Sir, can we relate to a foreign case law in deciding the liability of an auditor towards third party? Immediately after this particular, I'll be discussing a foreign case law only, which is related to Indian also, but I'll show you that how the American law or English law affects our country. The FS preparing management is also equally more liable, right? Yes, the prime responsibility of the management. So they are also held liable. But in a case, like the defendants can be multiple. Okay, so that's why we need to understand from the auditor's side also. If the issue comes outside the sample selected by auditor, then in that case, how auditor will be liable since it was out of the sample? See, in the audit, it's not only about the sample. If it was only about the sample, then it's fine. There are a lot of many things the auditor is required to perform in an audit. Let's say, for example, first of all, risk assessment. So whether my risk assessment was correct, if yes, okay, then on the basis of that, how much reliance I played on the control and whether that was correct. If that was correct, fine. Then I went to the sample testing because of the inherent limitation. And even in that, if there was nothing I identified, which resulted in that I should perform some more procedures, I obtained appropriate and sufficient audit evidence. Okay, in that case, I have not deviated from my standard care. That is the concept over here. Have I deviated from my standard care? that I was supposed to exercise, or have I deviated from the from the duties that I was supposed to exercise? No, I have applied the generally accepted auditing principles. I have relied upon and I have gathered that much evidence that was required to issue my opinion. I have fulfilled all the duties. Then there is no negligence on my part. That's why it's very important to understand what is the negligence. There's a deviation from the expected standard care. And expected standard care is defined by the auditing standards, that what you are required to do in case of an audit. Clear? Okay. I'll discuss one of the case. It's a recent case law. I'll discuss that. That is the PCOB report issued recently, I think, 6 December 2022. A recent PCOB report has been issued. There are certain things which are discussed in that particular report. I'll just highlight some of the things. Again, I'm not, for the name purpose, please do not focus on the names. I'm here to just to explain the concept. Okay. I'm not focusing on the name. I'm not focusing upon the other areas, who was the person who was against whom the report is. No, nothing. Please focus on the name. Strictly that's on the name. Okay. Again, that is the report that is available in the public domain. I would like to clarify on that, and anyone can access it. It's the recent order issued by the PCOB. So this is a final order that has been issued by PCOB, I think. Yeah. See, Public Company Accounting Oversight Board. Okay. This particular PCOB is for the US. Okay. Now, how this December 6th report is impacting in the Indian scenario. Now, one of the part here in this particular defendant was an Indian company, Indian entity. Okay. I'll not focus on the name, but in this particular case, upon the Indian auditors, there's a civil money penalties of 1 million US dollars has been imposed. Okay. Now, why? Because there were issues, and I'll discuss how the auditor was held liable in this case. Okay. So there were some violations, PCOB violations, PCOB quality control standard, violations that are discussed over here. Okay. See, generally PCOB quality control standard says that, same, establish the quality control procedures, that there should be quality. That is the expected standard care from us as a part of the PCOB. Okay. Now, here, I'll just show you the particular part that I want to show you. Just give me a minute. I'll show you the respective part. Okay. First of all, just want to show you, the proceedings have been initiated under the section 105 of the Sarbanes-Oxley Act, not an Indian. Okay. And the PCOB rule. So that is something, the foreign law applicable over here. Okay. Now, if I talk about, the concept that we are talking about, the liability of the auditor. So I'm talking about a concept basically where there was, discussed that, okay, failed to exercise reasonable care and skill. So as per the PCOB standard, okay, due professional care is to be exercised in planning and performing the audit. If there has been, violation, then it says that, okay, the particular standard care was not performed. Now, this is a case where, there was standard, there was a failure to exercise due professional care. Okay. And they violated some of the standards of PCOB standards. Now, again, in this case, PCOB standards were violated. Now, PCOB can PCOB impose penalty? Yes, because again, the expected the expected standard care was performed. The particular standard care was expected in this case, which was not performed, and the person, like the PCOB, was relying upon this particular report. Okay. So in this case, it's the PCOB who is holding liable, because PCOB was expecting a standard care from a person, again, that is within the Indian boundaries. But yes, this is how it impacts in the Indian case also. Okay. So it's not like that, that, okay, in case, if English laws will not be applicable, there are cases where the American law was applicable. Now, this is a recent example where the American law is applicable. Okay. But I just wanted to show you that in case of American law or American regulations are also applicable, because of the current scenario that, some of the Indian companies, Indian firms, Indian auditors are providing service outside India, or they are, the American law becomes applicable to them, like PCOB one. So it's really required to understand, what are the liabilities in the American and the English law. See, there is a good question, whether the auditor has to ascertain the list of persons who will rely upon the audit report. That's where the concept of deemed awareness is coming. You cannot ask a person, okay, the account, the management, okay, on to which bank you are going to submit. That is deemed that it will go to the banks and financial institution. It is deemed that it will go to the government. It is deemed that it will go to the various, creditors, members, stakeholders. It will be published in what you can say, outside. So that's why it is deemed that, it will be there in the public domain, available for the public. So damages for the negligence are there. Now I'll come to the sections of the Companies Act, okay, which clarifies further how the civil liability of the auditors comes into the picture for the companies. So first is a section 35, okay, which describes the civil. This particular section 35, which describes the civil liability, it is for the case of misstatement of the prospectus in prospectus, okay, where a person has subscribed any security of a company, or has relied upon the prospectus, okay, and the person and the particular prospectus was misleading, and the person has sustained losses. Again, he relied, the prospectus was misleading and sustained losses, okay, then in that case, the company and every person, like the directors or the person authorized by in the prospectus to be named in the prospectus, okay, the promoter, authorized issuer of the prospectus, or the expert, which are referred in section 5 of 26 in the prospectus, will be held liable for the punishment, okay, will be held liable for the punishment. Now so now the thing is here, that under what circumstances like this should be considered, like that person will be held liable. So here the concept is that, if there is a misleading statement and the person has relied upon that misleading statement, in this case the statement is the prospectus, okay, and the person has suffered losses. Three things: has relied, it was misleading, and losses. If these three are there, then only the every officer I have mentioned the name of the officer, they will be held liable. Okay, then only they will be held liable. Now, if you talk about particular section 35 of of the Companies Act that describes the liability, but there is one more thing in that particular section I want to discuss is basically subsection 1, or basically proviso, I can say, to that particular section 35. Okay, why? It's because it's very critical to understand. So sorry, my mistake, it's a subsection 2. Now the subsection 2 of section 35 says that, I'll write it down here. Section 35(2). Okay, section 35(2) says that this particular subsection 1, that the person liable will be punished, is not applicable. Okay, if that misleading statement was made by expert, so no person shall be liable under section 35(1) if this misleading statement okay was okay, or it was an extract from a report or valuation by an expert. Okay, and it was correct and fair representation of the statement. So plus it was correct and fair representation of the statement, means the correct copy of the statement was published. Okay, so whatever we have taken as an extract was correct or extracted correctly or fairly from the particular statement, okay, or the valuation report, plus had a reasonable ground to believe that at the time of issue of this particular prospectus, that at the time of issue of prospectus, okay, at the time of issue of prospectus, uh, the statement that was made by the person, okay, so that person who made the statement, who issued or made the statement, was competent enough to issue the statement. Okay, was competent enough to issue the statement, to make it, or to issue the statement, and and that person has given his consent, okay, has given his consent uh, required by section 26 to issue the prospectus, okay, so that his statement can be included in the prospectus. So person will not be held liable if this is the case. Now in this case, why the liability has been shifted upon the expert? Reason because if you see, it was a statement by an expert, okay, misleading statement was by an expert, it was extracted from his report, it was fair representation or correct extractions from the copy, there was a reasonable ground to rely upon the statement by the expert, and the expert gave his consent in the respective person because there was an expected standard care from that particular expert, there was a reliance upon the statement, okay, and the expert was aware, he has provided the consent, the expert was aware that his statement will be used. So in that case, the expert will be held liable rather than the respective person. That's why in this particular subsection, no person under section 1 will be held liable. Clear? So that is one of the case, one of the section, that is section 35, where the civil liability has been decided or has been there in for the misstatement in the prospectus. Now again, expert can be, here we are talking about engineer, valuer, charter accountant, all such experts are included here. Okay, so that was one of the case, one of the section. Again, the basic logic behind the section is that there was a reliance, there was the expected standard care from a particular expert. The expert was aware that where his statement is going to be used, and he provided his consent, and hence he will be held liable. Any doubt till now? Any doubt? Any doubt till now? See, there are various sections are there with which decides the liability. We will be covering those. Okay. Section 143 is also there that we have seen already covered, which defines the liability. Okay. We will be covering some more sections like criminal liability under section 34. Then liabilities under section 448, punishment for false statement, punishment for fraud, section 447 of Companies Act. Okay. Then there are certain other sections also, like decisions, decision taken by tribunal, directions given by tribunal under section 140. Okay, so we will be covering all those sections also, and some cases also. Then we will be covering professional misconduct under second schedule, schedule of the Chartered Accountants Act. There are clauses 5 to 8. I will be covering that also in a glimpse, that we have that already discussed that. But until now, any doubt? Okay. If no doubt, then what I can do is let's take a quick 10-minute break. After break, we'll gather back and we'll continue the discussions. Okay. Let's take a quick 10-minute break. Okay. So hello everyone, welcome back. Let's continue the topic. Now there is one question. Is there any comprehensive list where the auditor is going to be liable? See, if you want to identify a list where auditor is going to be liable, you need to understand which are the responsibilities of the auditor. So if I say section 143, auditor is responsible. Section 140, compliance with 140, 139, 141. Over there, section auditors is responsible. So wherever a chartered accountant's or auditor's responsibility is coming there, he will be liable if there is a breach of responsibility. So rather than focusing upon the list where he is liable, focus upon where there is a responsibility, and accordingly, that for each and every breach of responsibility, there will be a particular provision that will discuss upon the liabilities in the case of breach. So I'll suggest that will be a much more good approach compared to going for just by the liabilities thing. Okay. So that was section 35, where it was we were discussing about the civil liabilities. Now there is a section 34. Same way we discussed the section 35, there is section 34 of the Companies Act. Now section 35 imposes the civil liability, section 34 imposes the criminal liability. Okay. So in case of a criminal liability, what is the scenario is section 34 says that where a prospectus which is issued, okay, circulated or distributed as per the provisions of the Companies Act, and any statement in the prospectus, any statement, not a one particular, but any statement in the prospectus is untrue or misleading. Okay. So untrue or misleading, then every person who is authorized to issue such prospectus will be held liable under section 447. So liability is established under section 447. Punishment liable for 447. Okay. Now here the thing is that this section will not be applicable to a person if he proves that this statement or omission was immaterial and that he had a reasonable ground to believe that he when the time of issue of prospectus was there, the statement was true and inclusion or omission was necessary. So in other words, it is only when it is intentional. So the punishment is only when it is intentional. Okay. Now let's talk about the punishment of 447. What is 447? So section 447 talks about punishment for fraud. Okay. 447 is a section which talks about punishment for fraud. Now, what that section says that, I'll write it down here. So 447 talks about punishment for fraud. Okay. Now that section says that any person, for the under this particular provision. So where the question of fraud involves under this provision of this particular section. Okay, the punishment. Okay, if the public interest entity is there, it should be 3 years. Okay, not less than 3 years. It should be more than 3 years to 10 years. But in other cases, it's amount, if the amount involved is more than 10 lakh rupees, if the amount involved is more than 10 lakh rupees or 1% of the turnover, then imprisonment will be 6 months to 10 years, or fine equivalent to amount involved to 3 times of the amount involved. However, if it is a public interest entity, then this 6 months will become 3 years to 10 years. Means 6 months to 10 years will become 3 years to 10 years. Okay. So this is punishment for the fraud, which is intentional one. So in case there is a misleading statement in the prospectus, untrue or misleading, when it's intentional, then the punishment is punishment for fraud. Clear? Any doubt? Okay. Now, here in this particular section, what if the amount is less than 10 lakh rupees? Okay. The amount which is less than 10 lakh rupees. Okay. Or 1% of the turnover. 6 months to 5 years or up to 50 lakh rupees. That is the punishment. Okay. Now, another section of the Companies Act I want to discuss is section 140, subsection 5. We have already discussed in the company's audit. Let's go back to section 140. So section 140, subsection 5, what it talks about? Section 140, subsection 5 talks about the order of the tribunal. Okay. Now, in when a tribunal can pass an order, okay, so a tribunal can either suo motu or an application made to by central government or by any person if satisfied that auditor of the company has directly or indirectly acted in a fraudulent manner or abetted or collided in a fraud, okay, in relation to the company, its directors, its officers, then by order the company can direct to change the auditors. So by application, if the tribunal is satisfied, wait, okay. By application, if the tribunal is satisfied that if there is an abuse or if there is any fraud, auditor involved in the fraud, then in that case, central tribunal can pass an order to the change the auditor. Also, let me bring that particular section. Just a minute. Let me bring up section 145 that we discussed. Okay, here it is. Section 145 that we discussed, that if the tribunal finds that the auditor was involved in the fraud, okay, they can direct to change the auditor of the company. They can direct that auditor should be changed, like whatever auditor was appointed, they can change the auditor. Okay, that is a preliminary order that can be passed. But if on the final order, if the auditor is found guilty, then auditor is held liable under section 447 of the Companies Act. Okay. Plus, for the next 5 years, he will not be eligible for appointment of auditor in any company. He will not be eligible for appointment of auditor in any company, and he will be held guilty and punished under section 447. Now, what is 447 that we recently discussed? Punishment for fraud. That is, if amount involved more than 10 lakhs or 1%, 6 months to 10 years, and amount involved 2-3 times of amount involved. So that is the punishment he can get if he is found guilty. That is my 145 of Companies Act. Okay, if tribunal identifies if the auditor is involved into fraud. So any doubt till now? Any doubt? So yeah, there is one question. What are public interest entities? Okay. So public interest entities, if you want to see the public interest entities, so there's a list published by NAFRA, okay, which almost I think covers 6,500 entities with their auditors, which are, which NAFRA has covered under the category of public listed entities or public interested entities. So that list you can refer to, okay, that those are the public interested entities. So basically, public interest entities are the entities where public is heavily interested, or that company deals, in a large amount with the public. Any other doubts? Any doubts? Okay. Now, the next liability I want to cover here is provision under Charter Accountants Act. We have already seen clause 5 to clause 8 of of second schedule. What was clause? Okay, tell me, what is clause 5 of second schedule? Part 1 of second schedule. What is clause 5 of part 1 of second schedule? Let's see how many of you remember. What is clause 5 of part 1 of second schedule? Come on, guys, pretty easy. What is clause 5 of part 1 of second schedule? Correct? Correct, Sumit? Correct, Manini? Okay. Okay, good. Remember, we discussed about these clauses, clause 5, clause 6, clause 7, clause 8, when you were discussing about, professional ethics. I purposefully took these clauses together, 5 to 8. Reason because these clauses are directly related to the negligence. Okay. Gross negligence, when we talk about the term gross negligence. So auditor fails to disclose material facts, fails to report a material misstatement, does not exercise due diligence or is grossly negligent, fails to obtain sufficient information, or its exceptions or are that much material that they negate the expression of opinion. Purposefully, these clauses are taken together because these together, they all together make it, gross negligence for a particular auditor. So that's why it's very important to understand, these clauses together in a combined environment, so that you will have an idea what we are like. That's what the gross negligence is. So these are these clauses 5 to 8 of part 1 of second schedule, which have the liability on the auditor for gross negligence. Any doubt? Any doubt till now? Okay, so there is a question in section 447, punishment amount is lower of 10 lakh or one turnover. No, these are the conditions. Okay, so if the punishment, okay, let me go back to that. Okay, if the amount involved is more than 10 lakh rupees or 1% of turnover, then punishment is 6 months to 10 years, or amount involved or 3 times of amount involved as a fine. But if the amount involved in the fraud is less than 10 lakhs or 1% of the turnover, then imprisonment 6 months to 5 years, that the top limit of 10 years will reduce to the 5 years, and fine from amount involved to the up to 50 lakhs. Any doubt? Okay. I would like to show you something more. A recent order by NAFRA. Okay, it's a notice or order issued by NFRA, which discuss about the liability side of an auditor. Just for your purpose, just to have you guys just to give you guys clarity. Just let me load it. I'll show you. this is a particular order I will share with you guys, or it's available in the public domain also. That's nothing, that's a 22nd July 2020 order, which was issued by NFRA. I would like to bring your attention to some of the points that have been discussed in this particular notice. So basically, like when we talk about the liability of the auditors, okay, as I said, there are two types of liabilities which we discussed, criminal and civil in nature. So there was a particular case scenario. Okay, it's a high court's case. It was, a case of Gulab Chand versus Kudiral. Okay, now here it was, there was a disciplinary proceedings against particular charter accountant, and where it was, decided that, whether it will be a criminal prosecution or a civil prosecution. Very good case. I'll suggest, if you get some time, go and read this particular case. You will come to know how a criminal liability or an, a civil liability is decided. Okay, very good case of 1966. So that is there. Plus, there are certain terminologies like quasi-criminal in nature. So some of the disciplinary proceedings are quasi-criminal in nature, but not all. So that was the High Court's view that, disciplinary proceedings are not quasi-criminal in nature. Disciplinary inquiry is conducted by, various type of authorities, and it can be criminal in nature also. So if you want to have a good understanding, I'll suggest you go with that particular case law, have a read, have a good understanding, and you'll come to know how it has been decided that whether it's a criminal or civil in nature. Very good one. Also, in this particular order, they have taken very, very good examples with respect to, how in case, particular taking references from different acts, Indian Evidence Act, and how it is, decided whether it's a criminal nature liability or a civil nature. Again, that is totally dependent upon the misconduct, case to case basis. There is no single answer. Okay, this is criminal, this is civil. No, you need to understand what is the underlying situation is, what is the underlying misconduct is, and what is the underlying allegations are, basically charges. So in that way it is defined. As I was discussing clause 5, clause 6, of second schedule of part 1. So the same has been taken as a reference in this particular order also. Okay, where they have specified clause 5, 6, 7, 8, 9, and they have discussed how it is, more onto the side that decides the, civil liability of the chartered accountant. Okay, see, I'll just take you to the particular point I was discussing about. See, in clause 5, the portion but the disclosure of which is necessary to make the financial statement not misleading has been substituted by this particular term, like, but the disclosure of which is necessary in making such financial statement where he is concerned with the financial statement in a professional capacity. Okay, now, there is a this particular says that there's an absolute liability and responsibility on the auditor to disclose all the material facts known to him, irrespective whether the absence of such disclosure or effect making the financial statement misleading or not. Okay, so they also pay attention to the word should or shall, how it should be referred. And they also take, reference to the cases of USA and UK that I was discussing in the start as American scenario or the English scenario. Okay, so let's say, for example, in clause 7, the portion does not exercise due diligence has been added in clause 7. Okay, there is a definition of what is due diligence. So a stricter liability approach has been now brought by these changes. This is also in line with the advanced countries like USA, it's there, USA there. Okay, UK there. So this particular order is very good. I consider it, very good and understanding. This gives a good understanding of a particular, how a liability is decided. Okay. So I'll bring your attention to one of the point. Just a minute. So, so various provisions are enumerated in this particular, what you can say, this order. I will be that, I'll be sharing you this order also. Go through that, have a read on this particular order. A lot of things, has been clarified, and discussions have been put into that, how in a, with respect to all the factual evidence and documentary evidence, how a professional misconduct, how the liability is decided. Okay. So if you see, they have decided, okay, like, in the light of above discussion, meaning and scope of professional in the section. The charges in para have been proved, or something like the charges were there, but they were talking about the professional misconduct. Okay, in this whole order, what is the professional misconduct and what type of liability it provides to. So very good read. I can suggest, you can go and check. Very good read here. This was just for your purpose. Okay. Then there is one question. So before the final, okay, so this is related to section 140, 145, this one. Okay. If before the final order, what if the company changed its auditor, or the auditor resigns? Still the auditor will be held liable or guilty. If he is found guilty, he will be held liable. So it doesn't matter, if the auditor resigns from the company, or if the auditor is, still in the company. If he was found guilty, he will be held liable. Any doubt? Any doubt? Okay. Now, the next area I want to cover in the liabilities of auditor is the liabilities under Income Tax Act. Okay. I quickly cover. So the liabilities under Income Tax Act that defines, the liability of an auditor. They are covered under section 288, section 278, rule 12A and 271J. Okay, I'll explain each. So 288 talks about, a person who is convicted by any offense, he cannot appear before the authorities. So section 288 imposes section 288 subsection 4 and 5 imposes that, a person who is convicted or found guilty of misconduct in his professional capacity, that person cannot be present, or cannot, present himself in a professional capacity, or participate, as a legal practitioner, or he cannot attend any of the representations or meetings, or any of the, what you can say, representations before the income tax authority. So if he is, guilty of professional misconduct, he cannot appear before IT authorities. That is section 288, 4 and 5. Okay. Then section 278 talks about if a person, okay, abets or induces in any manner to any other person to make, to deliver him any account, statement, declaration relating to any income which is false. Like, for example, if I go to my client and I'll say, okay, you declare this much income, although you don't have this much income, you declare higher income, false income, or you do not declare this income. Okay. So if a statement or declaration relating to any income which is false, if I make that person to issue that statement, deliver that statement, then in that case, I will be held guilty, and it will be, that I have committed an offense under section 278. For that, I will be fined as per 267 of the Income Tax Act. Okay. So in that case, the penalty is in case where the amount of tax or penalty or interest which is evaded exceeds 25,000 rupees, then I'll show you the penalty. Okay. So where the tax, penalty or interest, okay, due to such declaration or statement that was accepted as a true statement, okay, and there was a willful attempt to evade, exceeds 50,000. Sorry, exceeds 2,500,000. Okay. In that case, there is a rigorous imprisonment for a term. There is a rigorous imprisonment for a term which shall not be less than 6 months, but which may extend to 7 years. So, imprisonment, you can say 6 months to 7 years. Then, in any other case, when tax, penalty, or interest is less than 25 lakh rupees or 2,500,000, okay, then in that case, imprisonment will be 3 months, which may extend to 2 years. Okay, so that is the penalty under section 2 for 278. Then there is a rule 12A. Okay, rule 12A talks about, chartered accountant who is authorized representative to prepare the return which is required to be filed by assessee, and if we furnish like false or untrue information in that particular, okay, return or statement that is provided to AO, in that case he will be liable for the punishment. Okay, he will be liable for the punishment, and it will be rigorous imprisonment. Now, when I talk about rigorous imprisonment, it will be, you can say, may extend to 7 years and a fine. So, imprisonment up to 7 years if there is a violation of Rule 12A. Now, the last section is section 271J of the Income Tax Act. If an accountant or a merchant banker or a registered valuer, okay, provides false certificate to any of the income tax authority or to assessing officer, commissioner appeals, then to department, then in that case the assessing officer or that particular authority may direct him to pay a sum of rupees 10,000 for each report or certificate for such certificate, by way of penalty. So rupees 10,000 for each such certificate can be there as a penalty if there is a false certificate or incorrect information. So that is 271J. Any doubt? till now? Any doubt? Okay, so there's a question that what is the difference between section 278 and 271J? See, 278 is something, I induce a person to make a false statement. Okay, so person, I induce a person that please make a false or make a false statement like that way. So that's something, I induce him. But in case of 271J, I make the statement in my professional capacity. So there's a difference between both. Here in 278, the statement is made by person, but in 271J, I make the statement in my own professional capacity. Okay. See, when we talk about rigorous imprisonment and normal imprisonment, so these are the terminologies that are defined under IPC. Okay, so rigorous imprisonment versus simple imprisonment, or you can say normal. Okay, so this is, has to do with the what do you say, the after imprisonment thing. Okay, so for example, when we talk about rigorous imprisonment, that is something, the person is required to perform rigorous jobs during his imprisonment. Okay, or let's say, for example, a person sentenced to simple imprisonment will have to do simple work in prison, but a person facing rigorous imprisonment has to perform hard labor during his term in prison. That is the difference between rigorous imprisonment and simple imprisonment. That depends upon, the type of work that has been allocated to a person in prison. That's the difference. Any doubts? Okay. See, if no further doubts, then let me take up one question. Okay, let me take up one question and then we can discuss further. Wait a minute, let me. So let me bring the question here. Just a minute. Okay, so there was a question in one of the exam, okay, that state the liabilities provided in the Companies Act for an auditor, for not appropriately dealing with. State the nature of liability provided in the Companies Act for an auditor for not appropriately dealing with a misstatement appearing in the audited financial statement or a false statement in an audit report. Okay, so this was one of the question in one of the exam. Now, when I talk about this particular scenario, see, not appropriately dealing with a misstatement appearing in the audited financial statement or a false statement in the audit report. So this points out to the various provisions that are there. So if I talk about the provisions here, it talks about like it's not only in the Companies Act, but there are professional ethics schedules also which requires us to report matters which are of you can say which are not which are misstatement or false in audit report. So my schedules like clause which we discussed are there, plus there are provisions in Companies Act that we discussed, like section 34 we discussed about the criminal liability, then we discussed about the section 35 the civil liability. Okay, then we discussed about section 140 if there is a fraud for there's an involvement of fraud. Then there are certain case laws are also there which talks about imprisonment of auditors, but majorly these are the cases. And these sections, section 35, 34, 35, 140, okay, then you can say 143, okay, and plus your clauses 5 to 8 of part 1, okay, are certain areas which deals with the misstatement appearing in the audited financial statement or a false statement in the audit report. Okay, so that is one of the area, one of the question at least it was. So yes, so there's a question: is criminal liability is only section 34 or any other section also? See, there are punishments for different sections in different for different kinds of acts. If I talk about just let's say some different punishments which are there. Okay, section 448 is a punishment for false statement. If you read that particular section, it provides if there is a penalty prescribed under 448, it will be punishment, that will be the punishment for false statement. So if you make any false statement in the financial statement, prospectus, statement, document, or any of the document that is prepared under the Companies Act, which is fault in any material particulars or which omits any material fact, then there is a punishment for that. Then there's a punishment for false evidence, punishment where no specific penalty is provided, punishment in case of repeated defaults. There are various punishments given in Companies Act, but the related to the auditors are the one that we discussed. So if you say are there any other criminal punishments? Yes, there are certain. But again, the punishments which we are dealing with the auditors have been discussed here. Any doubts? Any doubt, guys? See, the more you will ask, the more you will get a clarity about the topic. This topic is something like it covers a larger area. It discuss about the liability side of an auditor, like which are the liabilities that an auditor may face. Okay. So any doubt? Okay. If no further doubts, guys, then what I'll suggest is I'll start the next topic, that is the on internal audit of insurance companies. Okay, so we will be discussing the audit of insurance companies, and meanwhile, if you have any doubt, please feel free to ask. Okay. As I said, before I start the topic, before I go into the topic, I always prefer what is it? I provide the background. What is the topic? What we are going to cover? And what is the major thing that we will be seeing our responsibilities, liabilities, and as an auditor. See, when I talk about audit of insurance company, okay, there are three things that we need to understand. Number one, the laws and regulations that are applicable to an insurance company. Number two, the various provisions with respect to the this preparation and presentation of the financial statement and reporting requirements. Okay. And third is the additional liabilities, or you can say additional duties upon the auditor under the specific provisions that we are required over and above, what you can say, over and above the normal provisions for the reporting purpose. Okay. Now, when I talk about audit of an insurance company, okay, so which all laws will be applicable to me? Which all laws will be applicable to me? So first of all, let's say for example, my insurance company is XYZ Insurance Limited. I'm talking about this particular company, XYZ Insurance Limited, or XYZ General Insurance Limited, Life Insurance Limited, whatever it is. So which all laws and regulations it will be applicable to me? Which all laws and regulations will be applicable to me in this case? Come on, guys, pretty easy. which all laws and regulations will be applicable to me. Simple. So, okay, okay, I'll tell you over here. You tell me whether Companies Act 2013, is this applicable to me? Will this be applicable to me? Okay, correct, Manini. Yes, yeah, correct, Sumit. Correct, Boni. Yes. So Companies Act 2013 will be applicable to me because it's a company. Okay. The Insurance Act, okay, 1938 and amended from various time to time, will be applicable to me. Okay. Now recently there was in 2015 there was the Insurance Laws Amendment Act 2015, plus my insurance laws, regulations, rules, insurance rules 1939 will be applicable to me. Then IRDA Act, Insurance Regulatory and Development Authority Act 1999, which is amended again, was amended in 2015. Okay. I plus their regulations. Companies Act we discussed. Then there are IRDA investment regulations. Okay. Then there are IRDA preparation and presentation of financial statement regulation, preparation and presentation of financial statement and auditors report regulation 2000. So these are certain regulations which are applicable to a insurance company. Okay. Now I'll write one more law. You tell me whether that is applicable or not. So I'm talking about audit of insurance company. Okay. Whether SEBI regulations will be applicable to insurance company. Whether SEBI regulations will be applicable to insurance company or RBI regulations. Whether SEBI or RBI regulations will be applicable to insurance company. You need to understand whether these will be applicable or not. Okay, good, Bonnie. Whether RBI regulations, do you think RBI will govern insurance company? Or SEBI regulations? Come on, guys, pretty easy. You need to understand, like, the concept over here, like what is the scope first of all, that you are going to check when there is an audit? SEBI regulations or RBI regulations? Yes, SEBI regulations and RBI regulations will be applicable. If the company is listed, then SEBI regulations will be there, ICDR, LODR. So these regulations will be applicable to that particular company. Listing of listing and disclosure requirements, SEBI LODR regulations. And tell me when RBI regulations applicable. Okay, so when will be the RBI regulations applicable to an insurance company? Good morning. Somewhere near Boni. Not exactly, but somewhere near. Come on, guys, pretty easy. Where RBI regulations will be applicable? Correct. If a NBFC carries an insurance business, at that point in time, RBI regulations will also be applicable. So there are specific regulations for the NBFCs carrying, insurance business. So there's a guideline issued by RBI for entry of NBFC into insurance. Okay, so there are guidelines issued by the RBI also for NBFCs entering into the insurance, or even for the banks. There have been certain guidelines issued by the RBI from time to time with respect to their insurance businesses, like how they need to conduct two businesses separately. So it's not only one particular act. When we talk about audit of insurance company, it's not only the insurance act or insurance rules or IRDA related acts and rules. It's a wider ambit that you need to look into. Okay, so you need to look into a wider ambit. Now, if I go further in that insurance, now first of all, we need to understand what are insurance companies, where they are defined, and how it works. Okay, so the insurance company basically is defined under section, different type of businesses are also defined under section 2 of the Insurance Act. But I'll first of all take an Indian insurance company. Section 7A, okay, talks about the Indian insurance company. So what it says, that section 7A means an insurer, Indian insurance company means an insurer being a company okay, which is limited by shares, which is formed under companies formed and covered, and registered under Companies Act. And converted into converted into a company within 1 year of commencement of insurance business. That is one of the requirement. Okay. In which the aggregate holding of equity share by foreign investor, foreign portfolio investor do not exceed 74% of the paid up share capital. So foreign investment less than 74% of equity. Okay. And subject to other conditions of foreign investment which are there, whose purpose is to carry on insurance business, and plus whose purpose is to carry insurance business. Now, in this particular definition, there are three things that we need to see. Number one, what do we mean by insurer? What do we mean by insurance business? And the holding percentage to be an Indian company, that is the separately we will cover. But the first thing that we need to see is the insurance business. Okay. When I talk about insurance business, there are three types of insurance business that are specified in the Act. First is the fire insurance business. Which is specified under section 6A, 26A. Section 26A of the Act. 27A, sorry. So section 2 definition, then 7A, 6A, 6B, like this. And the second is general insurance business. Section 2, 6B of the Act. And third one is the life insurance. Sorry, health insurance. That is section 26C of the Act. Okay. Then the next is I actually, one more is there, want to add. Okay. Then one is life insurance business. Okay. That is again defined under section 211 of the Act. Okay. Now their definitions are provided. Like for example, when I talk about the fire insurance, it means the business of effecting otherwise than incidental to the insurance business related to the loss or accidental fire or other occurrence customarily included among the risks of fire, like this way. That's the definition given for the fire insurance business. Same with the general, same with the health. Okay. And is same with the life insurance business. Shall not go into the definition. We all know what these kind of insurance businesses are. Okay. So these are the top insurance businesses which are provided in the particular Act. There are some other also. Okay. Miscellaneous insurance business, marine insurance business. So if I talk about, let's say, marine insurance, that falls under section 213 of the Act. Then there's a general miscellaneous insurance business. Again, that is also prescribed under 213B. Of the Act. Okay. So there are different type of businesses which are prescribed, basically life, marine, and based on type of the activity that's been undertaken. Now, the second important point that we need to understand is the insurer. What do you mean? What do you the Act means by the insurer? Now, when I talk about insurer, so the definition of the Indian insurance company means an insurer being a company carrying on insurance business. So we saw different type of insurance business. But what is insurance? So insurer is defined under section 29 of the Act, which says that insurance means company, means Indian insurance company. So I'll write it down. Then statutory body established by Act, okay, like LIC, or insurance cooperative society, or foreign company engaged in the reinsurance business, okay, foreign company engaged in the reinsurance business through an established a branch in India. So that is the one. Okay, so these are known as the insurers. These are the insurers. Basically, they have specified. You can say, the body or the formation or the companies who can act as an insurer. Okay. Any doubt till now? Any doubt? Correct. It means, Sumit, it means yes. So there is a question, is FDI allowed till 74%? Answer is yes. As of now, for the Indian insurance company, foreign investment should be less than 74. You can say that means FDI allowed, but there are a lot of many conditions for the FDI. So the definition of general insurance. Okay. Basically, how it is defined as, in case of a general insurance, if you see the definition over here, the 26B. 26B talks about, means fire, marine, miscellaneous insurance business, whether carried on or singly or in combination. So general includes my fire, marine, and miscellaneous. All these three are covered in my, you can say, general insurance business. So life, health, and general are the three prime first categories. Then in general, rather I should do this way that you can have more clarity. Then general has three bifurcation of fire, marine, and miscellaneous. Okay. So first is health insurance, my life insurance and general insurance, these three. Then we have a miscellaneous, marine, and fire and general insurance. Any doubt till now? Okay. If no further doubts, then what I suggest is in the next lecture, I'll carry forward this particular topic, okay, of insurance company. I'll be detailedly explaining the regulations with respect to the audit of an insurance company. I'll be carrying out the questions. We'll be discussing questions. So please be, prepared with the topic, like, registration requirements, requirement for the minimum paid up capital or IRDA regulations. So remember, I talked about, there are IRDA regulations with respect to the preparation of financial statement and audit report. I'll be covering that in detail. Okay. And then we will be discussing about audit of accounts, appointments of auditor. So we will be discussing all those things. So please be ready with these topics in the next lecture. We will be covering in detail. And please provide your feedback. It is very, very important for me to understand whether you are, liking the lectures or not. It's very important. Okay, guys. So I'll keep this lecture till here, and in the next lecture we will be covering the insurance audit of insurance company in detail. Okay. Thank you, guys. Thank you for participating. Thank you so much. I'll see you in the next lecture.